Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at another requested stock. This time it's Anheuser Busch, ticker BUD, the alcoholic beverage giant. This stock took a huge hit during the pandemic, like everything else, and honestly has only been trading sideways since, hasn't really recovered. It hit a peak way back in 2016, and the downtrend was only worsened by the pandemic. And right now it's trading at the same range that it was trading back in 2010 and 2011. So, definitely an interesting stock to take a look at. So, let's dig right into it. But first, let's take a look at the beverage industry itself. So, I have some charts here. This one was kind of surprising to me. So, this is beverage companies in general, not just alcoholic beverages. And we see Anheuser-Busch, the stock that we're looking at here at the top, leader of all beverages sold in the world in 2022, followed closely by Nestle. I was like, what brands does Nestle own? They have a lot of water brands, specifically sparkling water. San Pellegrino, Perrier, uh, uh, they're both Nestle brands. So I am interested in taking a look at Nestle after I've looked into this. So that is on my list. Recently did a video comparing Coca-Cola and Pepsi. You should go take a look at that and see if either of those are a buy and what prospects they have. But clearly, Anheuser-Busch is the beverage king of the world right now, and we'll see if they're able to keep that up. We can see Starbucks here creeping up on Pepsi. So we got a mix here: alcohol, water, soda, coffee. But if we're looking strictly at alcohol, this is what we're looking at for the market. So it took a hit in 2020, kind of surprisingly, and is seeing some strong growth. So they're expecting it to move from its valuation of $1.48 trillion in 2022 to nearly $2 trillion by 2027, definitely by 2028. But beer is kind of on a downtrend, and spirits have overtaken beer. So people are drinking spirits more than they are beer. They overtook it in 2021 and continued in 2022. So we'll see what this year comes in at. It does look like the beer portion of the alcohol market is shrinking. Wine is shrinking as well. Spirits are really taking over. And so we come down to Anheuser-Busch being the beverage giant. That's the graph that we just looked at. But the surprising thing is, when you look strictly at alcoholic, Heineken is second place with half of the sales of Anheuser-Busch. And so that's what we're looking at for the industry. Anheuser-Busch is the leader, and it is a quickly growing industry with somewhere in the realm of 30% growth. So if they're able to maintain their market share, there is some good potential for them to grow their revenue. Here is where things sit right now. So with my calculations, I'm coming up with a fair value around $116. So if we go take a look at the metrics, we see last year it was 104, this year it's 117, next year it's 126. And this is mostly being fed by the balance sheet, closely followed by earnings, and then cash flows, and then the dividend. We do see the earnings growth overtaking the balance sheet in the future. And so there's some good growth prospects coming from there. But the actual numbers for the stock, it currently sits at 56.18. 52-week high of 67 and a 52-week low of 44. And if we're looking at the valuation metrics, we're looking at the low margin of safety on the stock of 87, which is $20 higher than the 52-week high for the stock. So it definitely looks like it is a undervalued stock. So we need to really dive into this and see what the heck is going on. Why is the market not trading at the fair value? I mean, it definitely was overvalued back in 2016 and has only been really trading sideways more recently. So earnings yield, it's pretty good. 4.85%, somewhere in the realm of 5% is great. Cash flow yield, very high cash flows, 14.08%. What is the growth on that? That's shrinking though. So they have high yields, but they're shrinking. Dividend yield 1.47, not a very consistent dividend company. We see 3-year CAGR of shrinking and 2-year CAGR of growth, and that's because they are all over the place with their dividend. They've paid $2 back in 2019 and then 57, 60, 53, 82. No idea what next year is going to be with their inconsistencies, but I'd say it's most likely at least 55. So I wouldn't say it's a very reliable dividend payment. It is a very low payout ratio as of the end of last year, so they could definitely raise it. ROE 8.13% is awfully low. And with a debt to equity ratio 1.75, that is awfully high. Definitely makes us want to look at the trend here. They are working on it, getting their debt down. They have a lot of assets on the books and quite a bit of debt. Red flag here, negative tangible book value. Gross profit of 54.48%, which is pretty good, very good, and a net profit of 10.33%, which is a good value as well. And right here we have the averages. So the average over this time period is 57.79 for the gross. So it does look like the gross profit is shrinking, and the average for the net is 9.86. So it does look like that's growing, which means they must be cutting expenses. And we can look into the numbers and see all of that. So the 3-year CAGR is surprisingly low for the growth in the market, but the 2-year CAGR is the double digits that we like to see. Expenses as a portion of revenue, we are seeing climb 69 to 72 to 74 to 75. So that's kind of a red flag. We do want to see that decreasing. And this is where the net margins were high and making it a higher average. 17% back in 2019, 3% in 2020, 8.6, 10.3. So they are on an uptrend, still down from their peak. Earnings per share, they're pretty good at growing it. Took a huge hit for COVID and got back into that $2 range and have been slowly increasing it, which is what we like to see. Share count, they are issuing shares, which is a red flag. It is a very low amount, but still, it's not really what we like to see. Free cash flow yield is great. It's been great around across the board. 15% is really good. So even if it is shrinking a little bit, that's not awful. They do have some room to go down before it becomes a bad yield. Like we said, tangible book value is kind of a red flag. Debt to equity is kind of a red flag, but on a good trend. Looks like tangible book value is on a pretty good trend as well. ROE, we like to see 20. We have nothing like that historically. 8.4%, 8.1%. So they're below 10%. And with the high debt, it should be even higher. So they have a very low return on equity. Not a huge surprise for the monstrous assets that they have, but this looks like a very capital intensive business, which does likely give them a pretty wide moat. So Fair value at the end of last year, like we talked about, 104 to 117 to 126. So we're seeing some good growth in there. Personally, I'd only be willing to pay about $76 for this. So let's look at the trends of everything. Great revenue growth. Cost of goods is growing pretty slowly compared to the growth in the revenue. Gross, net, and EBIT, we have a different story. We have a peak in 2019 and it went down, up, stagnant on all of these numbers, with a bit of a growth from 2021 to 2022 in the net profit. Balance sheet, we want to see those tangible assets trend positive. Looks like the assets are kind of trending negative, if not stagnant, and the liabilities are as well. So we can go back to the numbers and take a look at that and see what's going on. Yeah, 236, 226, 217, 212. So they are trending negative. Not a great sign. That's the powerhouse. That's where a lot of their value comes from, is all of the assets on the books. Cash flows, like we said, they're very consistent, not necessarily growing it, but they're holding at 15%, which is a very good cash flow yield. Dividend, like I said, they're all over the place. Very high 2019, and they're just hopping around. I tried to research what their dividend philosophy was, and I really couldn't find anything. So that is what we're seeing there. And then if we want to look at everything graphed, we see that balance sheets bringing most of the value, which has actually been surpassed by earnings come 2024 if they come in on analyst projections. And really the lowest value here is the share price. So it's clearly an undervalued stock. There's just a few things that I don't like about it, and that is the negative tangible book value, loss in assets, issuance of new shares, expenses as a portion of revenue climbing, and a low ROE. So that is a pretty big list. It's probably going to be a hold for that reason. Like, it looks like there's some good value here, but not the kind of quality that we would be able to rely on the stock reaching that potential value. And the consistency isn't necessarily there either. But that's what we're looking at for this one. So I want to thank you guys for watching. Please like if you enjoyed the video. Comment if there's any other stocks that we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.